Okay. So this chapter is a very interesting chapter again, and it's known as capital structure and finance costs. Okay. So we'll be discussing two things in this chapter number 13. So first thing is capital structure, and then second thing is finance cost. So let me first give you an overview of this, that what actually we'll study in this. So this chapter basically talks about all about the business finance, that how can a business generate a finance during its operations. So there are basically two methods for obtaining finance for a business, like how do they earn money, where do they get money. So first form is through equity, and second is through debt. Now, debt basically means, in other words, it's like a loan. So if you take a loan from bank or like a liability, it's called debt. And the second part of this is equity. So a business can also generate cash by equity, and equity, in easier words, it's known as shares. So the shares market, the stock market, in simple words, it is known as shares. So we will first be discussing the equity part. There is a lot of discussion in this, a lot of theory. There is a little calculation part, but I would say there is more amount of theory, but it's interesting and it's practical, and it all makes sense in practical life as well. And secondly, we'll be discussing the debt, the loan part. This will be the second part. All right. Okay, just a second. All right, so let's discuss first the introduction of this topic. Let's see what's written over here. So all companies have to be financed regardless of the type of company that they are. So either it's a sole trader, either it's a small shop, either it's a big listed company. All people, all the owners need money to run the business. So without financing of any sort of the business will not be able to begin trading. They would not be able to purchase raw materials, recruit staff, advertise products, or even put fuel in their vehicles. Yes, obviously. So finance is provided by capital invested in the business, and that I was telling you that this can be generated from two things, either from debt, either from equity. So capital, this has the same definition as we discussed in the day one as well. So capital is something that on its own has little or no use, but can be employed in the generation of wealth. So for generating wealth from the company, from generating some kind of a return from the company, we need to have a capital invested in that, so that it's kind of working and 24/7 working and giving us sales and profits that we want. Okay, now these are the two types, debt and equity, as you can see over here. So first, let's see the debt one. So holder of debt is entitled to some form of mandatory repayment. Yes, this is the one main difference between debt and equity. So what happens is that whenever you're going for a loan option, the bank says you that you have to pay interest on fixed date and fixed amounts. So that means nothing can be missed over here. We can't say the bank that, okay, I'll pay you two interests in the next month. I'm just skipping the interest in this month. You can't say this to the bank. Okay, there are fixed repayments amount at fixed dates. So this is one, you can say, disadvantage of debt. So like an interest or repayment of capital, these are at fixed time. But in equity, as you know, that in shares, we can sometimes we don't give dividend to the shareholders. Sometimes we do give dividend. Dividend, as you know, it is a profit share. Whenever all expenses are minus from the profit, the remaining profits are shared between all the shareholders. So equity holder is not entitled to any repayment. Instead, they share the residual assets of the business when it ceases to trade. So first of all, they get the profit share, right? Secondly, they can earn from increase of share price, right? This will be the motive of this chapter. So this is how the equity shareholders can earn money. There is no fixed element over here that in every case we have to pay them. There is nothing such as this. Now, there are a number of ways that business can attract financial capital, but each of it has its own characteristics and consequences. The first is debt. Secondly, there is equity. So in debt, what happens is it requires some kind of mandatory transfer of economic benefit to the provider of finance. So let's say you might have heard of floating charge and fixed charge. So whenever you go to a bank for obtaining a loan, they ask you for possession of a very material asset. Like for example, you have a very expensive car or a very expensive land in some other countryside or anywhere, right? So they might have to take a temporary possession for that, just because if unfortunately you're not able to repay the loan, they are secured in the form of that. So they can recover their money by selling your property, which you gave them as a fixed charge. So this happens in debt, but there is nothing such as this in equity. This is actually a very extreme version of the debt that in many countries this happens is that charges are basically set and they are basically transferred to the banks. Then they can sell it if the customer does not repay the debt. But in equity, this gives the provider of finance the rights to share in the residual assets. So again, this is involving the rights. We'll discuss more detail about the equity as well. Now, there are three main things in this. So this is over here talking about equity, because I told you that first we'll discuss the equity part, and after that, at the last, we'll come towards the debt part. Now, equity has basically three kind of things. First is known as ordinary share capital. Then there are loan notes, right? And after that, there are preference shares. So these are three main things which are involved as a financing for the business. Let's discuss the ordinary share capital. So this is one kind of shares. In easy words, we can call it shares. So this is equity, as the directors are under no obligation to repay the investors. So yes, in equity, there is no obligation. We can skip paying dividends even for 5-6 years. But in debt, what is the disadvantage? That we still have to pay fixed interest in fixed installments at fixed point of times. So shareholders ought to pay them as a dividend. And ordinary shareholding is evidence of ownership of a company, and shareholders receive the residual interest in the business once it ceases to trade in proportion. So let me write over here, shareholders earn through 3 points in their time of business. First, they earn from the dividends. Secondly, the shareholders earn from increase in share price. And thirdly, they earn, as it's written over here, that when the business ceases, they are given the residual asset portions. So these are the three main, you can say, sources of earning for the shareholders. Okay. Now, directors may choose to pay the shareholders an annual dividend. So the word over here is may. They don't have any obligation. They can pay, they may not pay. If there are not enough profits, they can also skip. They can pay, that's fine. So these are recognized in the statement of changes in equity. Again, the statement of changes in equity we'll be studying in the chapter where we will be discussing financial statements. It's towards the end, not the statement of profit or loss. So statement of profit or loss does not contain any kind of dividends. This is not a deduction from profit. It is a distribution of profit. Yes, it's a very right thing that it does not decreases profit, because everything we've already minused from the profit, the expenses, the director's salary, the wages, all the things. So this is actually the residual profit. So this does not involve any further deduction. This is just distributed among all people. Okay, now this was share capital. Then we have loan notes. So this is a kind of debt, you can say. This is a kind of debt. In easier terms, it's known as loan, but in formal terms, it's called loan notes. Now, what happens is, under the terms of loan note agreement, directors are usually required to pay the loan holder an annual interest amount and are obliged to repay the full debt at a fixed point in time. Now, obviously, you can see in every case, in every point, there are two parties, right? First party is the person who is investing, and second party is the person who is receiving the money, right? So for each of the party, there is some kind of disadvantages and some kind of advantages in this. Now, this is therefore a form of debt and appears as a liability in the statement of financial position. So again, loan notes is a debt. Now, let me explain you what actually loan notes are. Just a second. Okay. So let's say that this is the company, right? And this needs finance. This needs money. Okay. Now, what happens is that there are a group of people over here, right? There are a lot of people over here, and this company reaches out to them, right, and asks them that we need cash, so we will offer every kind of incentive. We will work on the company prosperity and all of the things, like directors boast about the company that we'll work on good profits, you'll receive good annual interests. So they reach the people, and some kind of people agree, and they start investing in this company, right? but they don't invest in the shares, they invest in the loan notes. Now, what is actually is no note? That this company will issue some kind of certificates. These rectangles I'm making, these are kind of like certificates, and these are known as loan notes. So this company who needs the finance, they will issue the loan notes to these people, and these people will in turn invest them in this company, right? So basically what happens is that loan note is kind of a written agreement that yes, you have invested in our company and we'll pay you interest at this fixed time. So this is the literal definition of loan notes. So loan note is kind of a certificate, it's kind of a document, you can say whatever, but loan notes are treated as a liability because they have interest payment involved in them. They're very difficult, they're very different to the shares and the equity shareholding. Okay. Now, interest payment is treated as a finance charge, which is shown as expense in the profit or loss. So actually this happens as well, that when, let's say we are taking a loan from the bank, so the interest payments will be called finance cost or finance charges. And this will be an expense. For every year, there will be a certain kind of expense that will be recorded in the profit or loss statement. So again, loan notes are also treated just as a liability, just as we have taken a loan. Now, finally, we have preference shares. This is just giving an introduction. Obviously, we have much more detail to discuss in just a while. We're discussing that. Now, preference shares, this is also one kind of shares. And the thing is that they are divided into two parts. Okay. Now, one part is known as irredeemable preference shares, right? And the other part is known as redeemable preference shares. So we'll discuss them both. Let's see. So always remember that if they're redeemable, if there is any obligation to repay the preference shareholder, that's why they are called redeemable, because redeemable means that we have to return the money as well. Then this is evidence of a debt. Obviously, this happens in bank loan as well, that if we are taking a bank loan, we have to return the money, right? It's not ours, we have to return at some point of time. So this is treated as redeemable preference shares. And if it is a redeemable one, this will be shown as a liability in the statements, because this is just treated as a debt. And the repayments, the interest payments that we do, these will be called as finance cost, finance charges, as an expense. So this is
okay, so this can be, yeah, debt or equity is the same. I mean,
no, basically the debt and equity have many differences, like I explained you in the start. That's why there are two forms of generating finance. Debt has some kind of advantages, some disadvantages, and equity has some advantages and disadvantages. They have some differences and similarities, but those are separate from each other. So always remember, if it's redeemable preference shares, it is treated as a debt, which is a liability. Now, if it is irredeemable, so in irredeemable, what happens is that we purchase irredeemable debts, preference shares, sorry, and irredeemable means that we will not have to pay the money back. If I am the company, if I am receiving the finance from the shareholders, shareholders are investing in my company. So if it is irredeemable preference shares, that means that I will not have to pay them back. So it is not treated as a liability or a debt. This will be treated as equity, because we are selling some control of our company. This thing you already may know, that if the shares are sold for some company, it is like giving small shares, giving small share of control to any person who's buying the shares. So irredeemable shares are shares that do not have to be repaid. They are therefore treated as equity in the financial position. It must be more clear that they are not the same as ordinary shares, as they do not entitle the owner to residual interest. So again, these are very separate to the ordinary shares that we looked at number 1 over here. So these are three main things that it has discussed. Obviously, there are more things as well. Now let's move on to the detail of them. First of all,
sorry. Redeemable, so it has to be treated as equity in the statement of financial position.
Irredeemable is equity, redeemable is always a debt. Okay. So you have to remember, look, redeemable, the word itself is giving us a hint that we have to pay back any money. Now, debt has one feature, one main feature, that anything which is to be paid back to the owner, that is a debt, right? That is a liability. Like, let's take an example of payable. Remember the credit purchases. So when we do credit purchase, we have a liability to pay back the supplier at some point of time, right? So the door for paying back money is open, right? It's not closed. So if the door is open, it's called a debt. It's called a liability. So redeemable preference shares, the only two parts over here is regarding the preference shares, not for the other ones.
Okay, but sorry, but the preference shares that are redeemable. So on one end, they are going to be recorded in the statement of financial position as liabilities.
Yes,
and
exactly.
the dividends as an expense.
Yes, exactly. Because they will be treated as an interest charge. Now over here, we're not talking about the shareholder. This topic, because whole of F3 focuses on the companies. So if we are the company receiving the finance, okay. So we're only seeing one side of the story over here. And if it is irredeemable, it is called a equity, just like normal shares. All right. Now we're discussing the more detailed part of ordinary share capital. Let's see what this actually is. So let's do one thing. Let's make it simple and let's discuss the detail over here in the notes over here. Just give me a second. Okay. So first of all, let's discuss ordinary share capital. Now what happens is that this is a form of equity, right? That means this will be recorded as capital in the statement of financial position, not as a liability under the equity section. Now there are certain words to be used over here, and according to those words we'll do the calculation, because this is the calculation based part in this. So the word over here is par value, or in other words it can be called nominal value as well. Now I'll move with the example over here. Let's say if you go to a stock market, you have to purchase some shares for a company because you find a company is very prospering from the past few years. It has very increased profits, so people are very happy from it. So you say that, okay, let's try and invest in this company as well, so that we also get all the benefits and the increase in share price, all the earnings. So let's say the market value currently in the share market, in the stock market, it's $5 per share. Okay, it's $5 per share. Now this $5, what I'm trying to say over here is that this $5 is divided into two things over here. One word that I've written over here is par value. So this has a par amount as well, and it has a premium as well. Now let's see in detail what these two actually are. So always remember, par value or nominal value is basically cost of share to the business, right? So if you are doing any kind of, like a business, if you have bought this clothing for, let's say, $2, and you're selling it to the customers for, let's say, $8, so you have $6 profit in between, right? So this is your cost, and if you minus the selling price from the cost, you'll get the profit. So same thing is happening over here, that if I say share price is made up of par value and a premium amount, right? So premium is actually known as,
the share price is the nominal value.
no. Par value is a nominal value, which is called over here, that I'm explaining over here. But share price is made up of both of them. Okay. Now premium is basically called the excess amount, the profit. In other words, you can call it profit as well. Par value is just simple words. In just simple words, it's known as cost of the share for the business, right? So just the bare cost. So if a business, if a company, if I am owning a company, I need some finance. So I have some kind of a cost attached to the share. And if I'm adding a premium, if I'm adding excess profit amount, I'll reach to the market value, right? The share price. So the same thing is happening over here. We add the par value and the premium to arrive at the share price. Now, par value, always remember, it's called nominal as well and par as well. Both are the same things. It's the cost of share to the business. Now, second thing, what was over here is premium. So premium, always remember, this is the excess or any kind of profit that the business is earning on every share. So these are two things in this ordinary share capital. Now, always remember, par value or nominal value will be very small in nature. It may be in cents or pennies, very small. We'll see in the question as well, because a business has millions, trillions of shares. Big companies, proper listed companies, have even billions of shares in the stock market that people can buy. So obviously, if they're divided by the total number of shares, the par value becomes very small, close to unidentifiable, right? But the main money, where that is coming from, it's coming from premium. This amount, main earning for the company is from the premium that it's earning. Okay. Now let's see from here as well. So same thing is written over here, exactly the same thing. You can read it if you want. This is exactly the same thing that I explained. So you can see that nominal value is often very small, like it can be $1, 50 cents, 25 cents. Okay, this was what I was trying to say over here. Now let's see if there is any kind of example. Yes, there is one example. First, let's do the double entries, and after that we'll do the example. But before that, there are three terms over here as well. These are related to the ordinary share capital as well. Let's see these one as well. So first of all, this is issued share capital. So whenever this word is used, issued share capital, this table does not come in the exam much. I have not seen it in history, but it's important to know just for the general knowledge as well. Okay, so issued share capital, let's see. It is the share capital that has actually been issued to the shareholders. The number of issued shares is used in the calculation of dividends. So as you can see, the word is telling us issued. So how much capital, the share capital, we have still issued to the shareholders. Now, second word is called up. Called up share capital is the amount of the nominal value paid by the shareholder plus any further amounts that they have agreed to pay in the future. Now, let me give an example of called up. Let's say the par value for this share, this example that I gave, the $5, is, let's say, $2. So if $2 is the par value, the excess amount will be how much? $3, right? So these two will make it $5. This is the market value, right? So the called up share capital is like, let's say the shareholder has given us $2 and is saying that I will give you $10 in future as well. So he has promised something us, he has promised us something, and he has given a par value upfront as well. So this concept is known as called up share capital. Like he has called it up, he has promised some kind of thing. Okay. Now paid up, this is the last one. Paid up share capital is the amount of nominal value which has been paid at the current date. So this is very similar to the issued one, but this deals with only the nominal value that is still paid with the shareholders. So again, this is not very much important for the exam purpose. It's just increasing for the knowledge. It's helpful for just learning about this topic. Now, the main thing over here is these double entries. These are very important. So let's see. Now I'll explain the double entries over here as well, the same way. Now, here is the same example. The market value is $5, the par value is $2, and the premium over here is $3, right? So always remember, there are two accounts maintained. One is called share capital account, right? And second one is called share premium account. Even if you look at any company's annual reports or like financial statements, you might see in the equity portion, these two things are written for every company, for every proper listed company. So in the share capital account, always remember that the par value is recorded. Nothing else, just the par value, because the share capital only increases with the par value. Okay. And in the share premium account, as the word over here is telling you, this only records the premium that is earned. Okay. So if a company is making a market value share, then what will be the double entry? This will be something like this: debit cash, credit share capital, right? And credit share premium. This will be the correct double entry, because one thing we know for sure, I've told you at day one as well, that any kind of capital is increased for credit, right? It's a group 2 item. So any kind of capital is increased for credit. So these both are equity items. These both are capital items. these both accounts.
The cash will be the total of share capital and premium together.
Exactly. Yes, exactly. Okay. So cash will be, we can say, this market value, this one.
Yeah.
And share capital will only contain the par value, and share premium will only contain the premium value. So let's take the same example, and let's say a shareholder bought 10,000 shares at this value. Now 10,000 multiplied by 5, this will give us 50,000. So the total cash, including the premium, including the capital we have received, is 50,000. Now what will go in the share capital account? 10,000 multiplied by 2, because 2 is the only par value over here. So 20,000 will go into the share premium, the capital. And in the share premium, what will go is 3 into 10,000, which is 30,000. So you can see, out of this 50,000, the company has earned the cost of 20,000, which is a share capital, and the premium of 30,000. This is the main earning. In most cases, this is the main earning for the company.
Okay, so $2 is the nominal value.
Yes, exactly.
Okay.
And this $3 is this premium, which is the excess amount, which is a profit that the company is earning on the shares.
Okay.
And these two, when they're added, they make up the market value on which the shares are being traded among the people.
Okay.
Now, in some cases, what happens is, there is a second case as well. What happens is that some companies are, they have a lot of cash. They don't need any kind of premium, right? So what the company directors decide to do is that they just trade on the par value. So that's why these company share price is very less sometimes, because it's just the par value. So in this case, there will not be a share premium account. So the entry over here will be debit cash and credit share capital. That's it. This will be the entry if the company chooses to trade on the par value, on the nominal value, if they don't choose to earn any premium on this. Okay, so this is the entry. Let's say in this case, this will be 20,000 and 20,000. If the company chooses to just trade on the nominal value, they don't involve the premium in this, then this double entry will be made. Okay, right. So the same thing is discussed over here as well. So if company were to issue shares at nominal value, this entry would be made, their debit cash, credit share capital. And if they would make a proper market value issue that involves the premium as well and the par value as well, then this entry will be made. Debit the total cash, credit share capital, and credit share premium. Okay, now let's do this example, this just your understanding one. So show this transaction using ledger accounts. We'll just make the double entries. So Bourbon Company issued 200,000 25-cent shares at a price of $1.75 each. Now, one thing that I wanted to tell you is that you can see the par value that I was talking about, it's very small in value. And one more hint is that it will be written just besides the total number of shares, just next to or just before that. So this is another indication of catching the par value. Number one, it's very short in, it's very small in value. And number two, it's written just next to or just beside the total number of shares. So in this case, as you can see, 25 cents is the par value and this is the market value, right? So if we want to find the excess amount, the premium amount, we'll minus the 25 cents from this, and the premium that we're getting is $1.50. Okay, now what will be the entry over here? Let's see. So debit cash, credit share capital, and credit share premium. Now let's see what amounts we'll put in this. So first of all, 200,000 into 1.75. Just a second. So this is 350,000 into 1.75, because this is the total cash that we have received. For the share capital, we are only writing the par amount, the nominal value, which in this case is 25 cents. So this will be 50,000, I believe. right? And for the share premium, 200,000, the premium we calculated just over here, it's 1.5, right? So 200,000 into 1.5, this is giving us 300,000. So the duality concept is also met over here. If we add both the credits, it's 350,000. So these are both equal to the debit side, which is 350,000. All right. So this is very simple to understand. This was a treatment, the accounting treatment for ordinary share capital. Okay. Got it? Right.
Yeah.
Now we're discussing some more elements in this, which are part of the ordinary share capital. So what happens is that there are two words over here, right issue and bonus issue. First, let's discuss the right issue. So in right issue, what happens is that it is the offer of new shares to existing shareholders in proportion to their existing shareholding at a stated price, normally below market value. So now what's happening is that always remember, right issue is done to only existing shareholders. These are not aimed at the new ones. So number one thing over here is existing shareholders. And secondly, this is given as much lower price than market value, because obviously company has to maintain the relations with the ordinary existing shareholders as well. They have to act nice, they have to act politely as well. So that's why they're offering at a much lower price, which is a discount than market value. So this is called a right issue. Now this will be in some kind of a proportion. We'll see in the example how this is calculated. The entry is exactly the same as above. Now what are the advantages for this? Let's see. Number one, a right issue is the cheapest way for a company to raise finance through the issuing of further share. Yes, no doubt. How is it cheaper? Let me explain to you over here. So let's compare a company. This is a company that is going to each and every customer, a new customer who is not confident in this company, and they're just persuading them, they're very desperate that please invest in our company. This will be very expensive. We will have to hire some agents as well, right? We'll have to incur a lot of advertisement costs, right? So this form is very expensive over here. But the cheaper source is that, let's say this company already has a large group of people who are already its investors. These people are already the investors. So if this company asks them to invest, they will already know what is the performance of the company. So they maybe all of them 100% are happy to invest, right? So that's why right issue is much cheaper than if you are issuing to totally new customers. So this was the logic in this. Now, secondly, a right issue to existing shareholders has a greater chance of success compared to share issue to the public. Obviously, if the sales agents and the advertising agents go on to these customers, the new ones, they will be very hesitant to invest. They will say, oh, we don't know, we have never invested in your company before. You might be falling below the average, you might have very bad results. But what happens in right issue is that these customers already know the company because they're already the shareholders. So it's much easier, it's a greater chance of success in this case number 2 over here. Okay, so these two are advantages of right issue. Now what are the disadvantages? What are the bad things over here? A right issue is more expensive than issuing debt. In the exam F9, there is exam in ACCA, it's called F9. You will study a lot of proportion of this topic, this point, this only one point, which has, I think, 8 or 9 or 10 words. This has 3 full chapters in the book of F9. Like the chapter name is that why debt is cheaper than equity. So you'll study a lot of detail over there as well. But one thing is known in financial accounting is that debt is always cheaper than the equity, because there are a lot of factors. That factors will be discussed in future papers. So one thing we have to know, that debt is always cheaper. That's why this can be expensive than debt. Now it may not be successful in raising the finance required. Obviously, if we are reaching out to customers, it's not important that all the 100% customers agree. Maybe just 70% agree. And obviously, if we are giving at some kind of discount, then we might not be able to achieve full amount that we are investing. Like, let's say the company is looking for 6 million pounds, right? And it has just done a right issue, and that right issue just resulted in, let's say, 2.5 million. So there are a lot of money that is short from here, right? So what will the company do for that? So this is one disadvantage that we need to consider in right issue as well. Okay, so this was right issue theory. Most of it was theory. Now let's see how this will be accounted for by doing this example. Just give me a minute, just a second.
Yeah.
Okay, so upon incorporation in 2014, the JD company, a limited liability company, issues 1050 cent shares at a nominal value. Needing further funds in 2015, just 1 year later, it made a right issue of 1 for 5. So both in bonus issue as well, that we are going to study in just a while, and in right issue as well, you'll find this word very popularly used: 1 for 5, 2 for 3, 1 for 7, right? So I'll explain you what this actually means at $0.75. This offer is fully taken up. So first what happens is that in 2014, let's actually solve this question over here. So in 2014, normal shares are given to new customers, and that are 1000 shares at nominal value. So there are 50 cents, right? 1 second. 50 cents is the par value, right? Yes. So that means there is no premium over here. So the company is only issuing on the par value. So what happens is debit cash, credit share capital. That's it. No share premium is involved over here. So how much were the shares? 1000, and each share was 50 cents. So that means this is $500. So debit cash with $500, and share capital is also credited with $500. Now we need to see, in order to calculate the right issues that is made to the customers, we need to see how much shares already exist in the company, how much number of shares. So only 1000 shares have been issued till yet, right? Now you can see the word over here. 1 second. This one, 1 for 5 at 0.75, right? So you can see over here that maybe the market price was, let's say, I'm just taking an example. So let's say the market price was 1.5. And this is the motive of right issue, that they're given to the existing shareholders at a discounted price, right? So they're giving a discounted price at $0.75. So 75 cents. Now, first, let's see how we will calculate how much right issues have been made. So this word 1 for 5 actually means that out of every 5 existing shares, 1 new right share was given. Now let me write the definition for this as well, so you can easily understand. For every 5 existing shares, 1 new right issue was made. Okay, so this is the meaning for this 1 for 5. Let's say if this word was, let's say, 2 for 3. Now let's interpret this. So this means for every 3 existing shares, for every 3 existing shares, 2 new right shares were issued. So this is the easier version for this to understand. 1 for 5, 2 for 3, it can be 1 for 7 as well. So everything which comes after the forward is called the existing shares, and 1 means that a new 1 right issue is made, right? So the easier form of doing this is, if we have to find the right shares, that how much right shares were issued, what we do is 1000, these were the existing shares, so into 1 divided by 5. Because when we divide by 5, this means for every 5 existing shares, right? And when we multiply it with 1, this means that every new share is given, 1 new share. Was it 1 for 5? Yes, it was 1 for 5.
Yeah.
Now let's see what's the answer over here. I think this will be 200. Yes. So that means 200 new right shares were issued. These were not given at normal market value. These were given at a discount. And how much was the market value in this case? The discount, let's say the discounted value was $0.75. Okay. So one thing we know for sure, that the par value, it's written in the question, it's $0.5, 50 cents. You can see it's written over here. 50 cents is the par value. So in this
Yeah.
case, the company has also earned some kind of premium, but a lot lower, because there is some kind of a cost for giving it to the existing shareholders. So only 25 cents premium is earned over here. Now let's make a double entry for this. So what we'll do is debit cash, credit share capital. The double entry is completely same. So share premium. Let's see what was the total cash. So it was 200 into 0.75. So this is 150. 150, and share capital is basically 0.5 into 200. This is 100, and share premium is the excess amount multiplied by the total number of shares. So 0.25 into 200. So this will be 50. So only $50 premium is earned over here. $100 was the share capital, and total it makes it as $150. Okay, so this is the concept of right issues, right shares.
And so the premium is the difference between nominal value and the right issue cost.
Exactly. So premium is the difference between the total cash received and the par value.
Yeah.
Okay, right. So I think let's take a short break, because this chapter is, I think, somewhat left over here as well. So we'll try to finish it as soon as possible. Let's take, let's say, 5 to 6 minute break, right? And after that, we'll continue with bonus issues. Okay.
Okay.
All right, let's continue. Let's see the next thing right now, which is called bonus issues. Okay, so we have discussed the right shares over here. Now we are discussing the next thing, which is called the bonus issue. Okay, all right.
Okay.
So bonus issue, let's see what this is. So right issue, again, remember the two things that were there in right issue, the two main feature. One was existing shareholder, it's given to the existing shareholder. And secondly, it was issued at a much lower price, at a much discounted price than the market value. Now in the bonus shares, what happens is that in short, you can just remember it as free shares. We'll discuss the definition of this in just a while, but in short, it actually means free shares. Okay. Now let's read it from here. So the issue of new shares to existing shareholders in proportion to their existing shareholding, no cash is received from a bonus issue. So if I am the company issuing the shares, if I am the company who needs the finance, so these are kind of treated as a free share. So this is kind of like my expense, right? I'm receiving no cash. So where will I fulfill the loss from? Now let's discuss that as well, right? So these involve no cash received. First, let's see the advantages and disadvantages. So first advantage of this is issued share capital is divided into a larger number of shares, thus making the market value of each one less, so more marketable. Yes. Now let me explain you this point with the help of some numbers. Okay. In the stock market, what happens is that each company's share price, it's not just blatantly given, right? It is calculated with a lot of precise, a lot of factors are involved in that. Now let's see what actually happens is, let's say um, the total earning of that company, the total financing of that company is $6 million as yet, as now, and the total shares that it does have is 6,000, let's say. Okay. Or let's make it 6 million. Okay. Now if the total earning is $6 million and the total number of shares is 6 million, the number of shares, so that means what is the per share value? It is $1, right? It's $1 per share. So that means if we are giving the bonus issues, if we are giving the bonus issues, then what happens is that we are giving them away for free, right? So that means that this will change this figure, this will increase this figure, this will increase this figure, but it will do nothing to the dollar amount because we are not receiving any cash, right? We are not receiving any cash. So that means this 6 million will remain the same. And let's say this goes up to 7 million, right? So what happens is that, let me calculate the exact amount. So this will give us, yes, so this will make the share price at $0.85, right? So it's making the value of each share less, right? So that's why people will see that, oh, the company's performance is very good, but why is the share price decreasing? So let's buy the shares. This is the mindset of the investor, what it's thinking. So again,
Sorry, I didn't get it.
let me explain it again. Okay. So this is basically called dilution of control, dilution of EPS, or anything you can call this. In detail, you will study in the exam F7, which is the next exam for the financial reporting. Okay. So what happens is that whenever we are doing a bonus issue, so bonus issue, as you know, it involves no cash received. So it's kind of like free shares, right? So
Yeah.
let's say normally what happens is that in stock markets, how is the share price calculated? The total earning, the total financing divided by the total number of shares. So let's say as yet, before doing the bonus shares, the total share price was $1 per share. Okay.
Yeah.
Now, if we have done the bonus issue now, so what will happen is that, let's say the number of share increased to 7 million. From 6 million, it has gone up to 7 million. But
Because
it
we
will
issued
do
more shares.
exactly. We'll receive more, we'll issue more shares, more number of shares, but in return, we are not getting any kind of cash, right? So the cash amount,
So
the
what's the
dollar,
point of that?
because this is just given for, just for the trust of the shareholders, so that they don't leave us,
Okay.
they just keep investing. Because even if we give some free shares, this will be offsetted sometime in future. They might tell their friends and family by word of mouth that please invest in this company, these have very good financial results. So this
Yeah.
will sometimes bear the fruit of that. So what's happening is that dollar amount does not change, and the denominator amount, yes, this changes. So that means it becomes the lower amount. So share price keeps on decreasing and the performance is still increasing. So people will be very surprised. So what they'll do is that they'll start investing more. So this is one advantage of this. Now, secondly, issued share capital is brought more into line with assets employed in the company by reducing stated reserves and increasing share capital. So when we'll do the double entry as well, this still increases the share capital. That means the number of shares are increasing, but for cash, nothing is happening. So what's happening is that this is just in line with the assets employed. This point you'll understand more when we study the ratios chapter, because in the ratios we'll study a ratio regarding the percentage of assets employed in the business, which is basically revenue turnover. So just ignore the second
Okay.
point right now. First is the main advantage for this one. And the only
Okay.
disadvantage over here is that admin cost of making the bonus issue. Obviously, we will have to employ some administration persons as well. We might have to, train more persons. We have to recruit more persons. We are giving them money, but in return, we are receiving no money. So obviously, it will be a cost, a huge cost for the company. This will be one disadvantage. But again, the advantages are more than the disadvantages in this case. Okay. Now what we'll do is that this is the double entry for this one. So what we do is credit share capital just with the normal thing that we're doing. There is no cash received. So what we do is that where do we offset the loss from? We are making a loss over here, obviously, right? So what we're doing is offsetting the loss from share premium. So we debit the share premium in this case, because share premium will be there due to previous share issues, right? Like let's say 6 million, $10 million share
Yes.
premium is available. So from that we are offsetting the loss. So we do debit share premium and credit share capital, because still share capital is still increasing in this case. Okay, right? Now let's discuss the example over here. Let's see what this example is. So JKL company, a limited liability company, has 20,000 shares, 50-cent shares in issue, each issued for $1.25. So this is the normal market value. It makes a 1-for-4 bonus issue. So again, this is the word 1-for-4. This means for every existing 4 shares, we are issuing one new bonus share. So capitalizing the share premium account. Okay, let's see what will happen. So first of all, okay, what it's asking is what are the balances on the share capital and premium after making the bonus issue. All right, let's first do the normal issue, the 20,000 issue. Okay, so 20,000, this will be debit cash, credit share capital, and credit share premium. Now let's see what is the total cash that is received. So it's 20,000 shares and the market value is 1.25. So 20,000 into 1.25, this is 25,000. So the total cash received is 25,000.
Okay.
And for the share capital, we just take the par value. So 20,000 into 0.5. So this is 10,000. And obviously the excess will be 15,000. That will be a share premium. Okay. So this is a normal issue. Now we are making the bonus issue. So how much shares currently that we have issued 20,000, right? So for finding
Okay,
the
just one
bonus.
moment, because sorry, I'm just writing down everything. Sorry.
Yeah, sure. You can write first. We can then continue.
Yeah, just
Okay.
one.
Sure.
Share premium. So share premium, okay, is the difference between nominal value and market
the total
value.
cash. Yes, exactly.
Okay.
Okay. Now, so for the bonus issue, we have to first find the bonus shares. Okay. So what is the original number of shares that is issued? The normal shares, it is 20,000, right? So for finding the bonus shares, 20,000. Now you can see the word over here, 1-for-4. So this means for every 4 existing shares, one new bonus share is issued. So this is the meaning of this word 1-for-4, which is written. right? So what we'll do is multiply it by 1 divided by 4. So we'll just do 20,000 into 1 over 4. So this will give us the answer of 5,000. So that means 5,000 is the number of bonus shares that we have issued. Now let's make a entry for bonus share as well over here. So what we do is debit share premium, because we are offsetting the loss from this, and credit we are doing share capital. Now this is only done with the nominal value as we studied above. There is no market value involved in this because we have not received any kind of cash in this, right? So 5,000 into 50 cents. So that means 0.5. This will be 2,500. And same is the case for here. 5,000 into 0.5, 2,500. Okay, so this means
so when we calculate the bonus, we always take the nominal value.
Exactly, just the par value. So share premium will also be decreased with the par value, and capital will also obviously go up with the nominal par value. There is no market value or cash involved in this. Okay, now it's basically asking us the result, the balance for share capital and share premium. So let's see what it actually will be. So for share capital, it is 10,000 first, right? And then it is reduced by 2,500. Now let's see. This is share premium. Sorry. First share premium and then share capital. Okay, now let me write it over here. Let's write the share capital over here. So share capital first was 10,000 and then it went up by 2,500 more. So 2,500 will be added. That means this will be 12,500, right? And what about the share premium? First it was 15,000 resulting from the first share, and then it went down by 2,500. So 2,500 will be minus from here, right? So what will be the result over here? I think this will also be 12,500.
No,
Yes.
but sorry, share capital is going, is going up by 10,000. That's
Yes.
fine.
No.
Why do we put 25,000?
This 25,000 is the total cash receipt, right?
Oh yeah, 2,500 is there. Okay.
Yeah, 25,000 is the total cash, right? We are just looking at the individual amounts. So this is the capital, and you can see the capital again went up in the bonus issues. So 10,000 and then 2,500 is added, right? And in the share premium, this is the amount, this 15,000. So first it went up by 15,000, then it came down by 2,500 share premium, because we have issued the bonus issue, right? And the loss is offsetted from the share premium. So you can see the balance for share capital is 12,500, and for the premium it's also 12,500. So the right option for this will be option B. Both amounts will be same in this. Okay, right? So I think let's keep it till here today. I think just 2 things are left in the chapter, and that 2 things will take another like 20, 25, 30 minutes. We'll discuss them in tomorrow's class, right? And we'll also do the questions for this topic, and obviously also your issues, whatever problems that you're having in the questions.
Okay, tomorrow, can we do a 10:15 as well?
Sure. We'll start either at 10:15 or 10:30 between this time. Okay.
Okay, that's fine. Great.
All right. Thank you. I hope all of these things are clear. Is there any confusion?
Yeah. These are fine.
Okay,
yeah.
okay.
It's just, I just want to check with you the question from the exam kit tomorrow, because I'm like.
Sure. We'll discuss certainly tomorrow. Okay. All right.
Okay. Thanks a lot, man.
All right. Thank you. Have a good day. Bye-bye.
Thank you. You too. Bye-bye.